I've said it before and I'll say it again. The first rule of compounding is simple. Never interrupt it unnecessarily. And the fastest way to interrupt compounding is to lose money. Sounds obvious, doesn't it? Too obvious, like telling someone not to stick their hand in a fire, yet the world is full of people with burned hands. I've been investing for more than half a century, and I've seen everything: markets rise and collapse, recover and collapse again. I've watched geniuses go broke and ordinary people get rich. And if I had to boil it all down to one single idea, it would be this: the people who survive are the ones who avoid stupidity better than they chase brilliance. When I was a boy in Omaha during the Great Depression, it wasn't some chapter in a history book, it was life. Men with good jobs were selling apples on the street. Families were losing their homes. You could buy a fine farm for the price of a used car. And the lesson was painfully clear. If you took on debt and the tide went out, you drowned. That if you stayed conservative, if you kept your head, you survived. I saw families destroyed not by bad luck, but by overconfidence. They believed tomorrow would look like yesterday. It didn't. That era cured me of optimism about human rationality. People don't learn as quickly as you hope. Fast forward a few decades. The 1970s, inflation was eating people alive, stocks collapsed, oil prices quadrupled, and again, smart people, people who should have known better, lost fortunes because they borrowed too much, believed too much, and thought they were entitled to easy wealth. I wasn't a genius, not then, not ever. I was just cautious. I avoided debt. I avoided the hot tips, the fads, the noise, and because I avoided losing big, compounding worked quietly in the background year after year, decade after decade. Now, losing is more important than winning. People hate hearing that. They want to win big, triple their money by Tuesday. That urge has destroyed more wealth than poverty ever did. Think about Las Vegas. The lights on the strip aren't paid for by winners. They're paid for by losers who thought they had a system. The stock market is no different. It's just a bigger, better dressed casino. I once invested in a company that looked cheap, a classic cigar butt deal. One puff left, maybe you get a free smoke. Well, the smoke was free, but the stink stayed with me for years. I learned the hard way that cheap junk is still junk. That mistake probably cost me more money than I care to remember, but it taught me a lesson that no textbook could. The price of avoiding stupidity is far lower than the price of fixing stupidity. If you want to know how to avoid losing money, start with this: cut out the obvious disasters. Don't borrow money you can't repay. Don't buy what you don't understand. Don't trust people who make money selling advice, and never believe you're smarter than the market. You can make a fortune simply by surviving. Warren and I never tried to get rich quick. We just tried not to go broke, and that small difference compounds into something enormous over a lifetime. Forget brilliance, forget being clever, forget trying to outsmart everyone in the room. Just make fewer dumb mistakes. That alone will make you rich. But if that sounds boring, if you think you're the exception, go ahead, chase the next hot stock tip. The market will be happy to take your money. And while we're on the subject of destroying wealth, let's talk about envy. If you want to ruin your life and your portfolio, envy will do the job faster than any market crash ever could. Envy is the dumbest sin that doesn't even make you feel good. Lust can be fun. Gluttony at least tastes good. Pride feels nice for a while, but envy is like drinking poison and waiting for the other person to die. I've seen people make perfectly good money, live perfectly decent lives, and end up miserable because someone else did slightly better. Their neighbor drove a nicer car, their classmate bought a bigger house, their colleague got rich faster. Suddenly, they weren't content anymore. They started taking stupid risks just to catch up. That urge destroys investors. Instead of sticking to sound principles, they chase whatever's working for someone else. Tech stocks in the 1990s, real estate in 2006, crypto in 2021. Different decades, same stupidity. Warren and I never wasted time on envy. We didn't care if someone else doubled their money while we sat still. We knew sitting still with the right asset was often the smartest move of all. It's not easy, but it's simple. During the dot-com bubble, everyone was bragging about internet stocks. We looked like fools for staying out. Some of those stocks went up tenfold in a year. Our friends were paper rich while we looked boring and old-fashioned. Well, a couple of years later, most of those paper fortunes turned to ashes, and boring old Berkshire Hathaway just kept compounding. Envy cost those people fortunes. They weren't satisfied with their own game, so they copied someone else's badly. They thought they could leapfrog their way to glory. Instead, they jumped off a cliff. Envy also makes people miserable long before it makes them broke. I've known men who couldn't enjoy their yachts because someone else had a bigger one. That's not wealth, that's slavery. Someone will always be getting richer faster than you. So that one line can save your agency and maybe your fortune. Because here's the truth. Most envy-driven moves look like brilliance for a short time. You get lucky, you brag, people think you're a genius, then the tide goes out and suddenly you're exposed naked, broke, embarrassed. You don't need to win every race. You just need to stay in the game. The person you envy today might be bankrupt tomorrow, and if you're sensible, you'll still be standing. So stop blocking at the scoreboard. Focus on your own game. The race is long, and most runners won't finish. Your only job is to stay in the race without tripping over your own stupidity. That's how you win, by not trying to keep up with the idiots. Let's talk about overconfidence, the silent killer of wealth, health, and common sense. When you're young, overconfidence just costs you a few years and maybe a few $1,000s. By 60, it can cost you everything. The problem is simple. Success fools people. A few decisions, a few lucky breaks, and suddenly you start thinking you've cracked the code. You haven't. The world just hasn't punished you yet. I've met hundreds of smart people who went broke late in life, not because they got dumb, but because they got certain. Certainty is poison. It replaces curiosity, humility, and caution, the very qualities that keep you alive. Let me give you an example. Back in the late 1960s, I knew a man who'd done everything right. Saved money, invested carefully, retired early. Then he decided he was an expert in growth stocks. He borrowed, leveraged, and poured his savings into companies he didn't understand. Why? Because everyone else was doing it. When the market crashed in 1973, he lost it all. 50 years of discipline wiped out by 2 years of arrogance. At 60, 70, 80, you can't afford that mistake. You don't get another cycle to rebuild. The market might recover, but you won't. So how do you defend yourself? Simple. You assume you're ignorant. You assume you're biased. You assume you can be wrong. And then you build systems that protect you even when you are. That's not pessimism, that's realism. Warren and I structured everything at Berkshire around the idea that we might be wrong. We stayed diversified, kept a mountain of cash, avoided leverage, and never bet the farm, because we knew the people who survive longest aren't the ones who are right most often. They're the ones who stay solvent when they're wrong. Here's the truth. Most people don't like hearing. You can be brilliant and still go broke if you ignore probability. The markets don't care about your IQ or your resume. They care about math. A few bad bets with big downside and small upside will erase decades of progress. So, at 60 plus, stop trying to be clever. Stop thinking the next trade will make you rich. Stop believing your gut is a crystal ball. Your gut is just your emotions with a stomach ache. Instead, develop the habit of saying, I don't know. That phrase is pure gold after 60. It saves you from risky bets, loud opinions, and dumb arguments. The older I got, the more I realized that admitting ignorance isn't a weakness, it's armor. Here's what overconfidence looks like in real life. A retiree who moves his savings into crypto because his nephew got rich on it. A doctor who thinks market success proves he's a financial genius. A man who mistakes a 10-year bull run for his own brilliance. And here's what humility looks like. Someone who sticks to boring index funds. Someone who doesn't touch leverage. Someone who says enough and means it. Humility won't make you famous, but it will keep you free. Here's a rule that saved me countless times. If you can't explain the investment in one clear sentence, you shouldn't own it. Complexity hides risk. Simplicity exposes it. The older you get, the more your job shifts from building wealth to protecting it. That's not defeat. That's evolution. When you're 30, you can swing for the fences. When you're 70, you just need to stay on base. Because here's the hard truth. Past a certain age, the goal isn't getting rich. It's staying rich, staying sane, and staying alive. And that requires humility, the rarest form of intelligence there is. Let's talk about work and why most people never escape it. When you're young, you think work is about climbing, titles, promotions, a corner office, maybe your name on the door. You spend decades trying to move up a ladder that, if you're not careful, was leaned against the wrong wall to begin with. See, there's a huge difference between working for a living and building a life. Most people never figure that out. They trade their time for money, then trade their money for distractions, then wonder why their toe feel empty. The problem isn't that work is bad, it's that most people pick the wrong kind. They pick work that pays instead of work that compounds. When I say compounding, I don't just mean money. I mean reputation, skill, relationships, the invisible assets that multiply quietly in the background while you sleep. That's how you build freedom, not by hustling endlessly, but by building things that keep working when you don't. You can spot the difference easily. Employees ask, what do I get paid this month? Owners ask, what am I building this decade? Employees think in paychecks. Owners think in principles. Employees chase recognition. Owners chase resilience. Now, not everyone can own a business, but everyone can think like one. Ownership thinking means you look at every decision through the lens of long-term consequences. You stop trying to look busy and start trying to build leverage, systems, skills, and relationships that make future work easier, not harder. When you're 20, you can grind, you've got energy to spare. When you're 60, grinding is just a fancy word for self-destruction. You need leverage, things that scale without you. That might mean owning equity, building trust, or mastering a skill so rare the world pays you just to keep doing it. Warren and I built Berkshire that way. We didn't clock in and out. We didn't chase trends. We built systems that earned money even when we were asleep. And when you do that for long enough, something magical happens. Work stops feeling like work. You still show up, but not because you have to. You show up because you want to. Here's something young people almost never understand. You can't buy independence. You have to build it. No paycheck will ever make you free. Only ownership will. Ownership of assets, ownership of your decisions, ownership of your time. And here's the trap most people fall into: lifestyle inflation. You make more, you spend more, and before you know it, you're on the same treadmill at a higher speed. You feel wealthier, but you're not freer. Your expenses own you. Let me give you a test. If you stopped working tomorrow, how long could you sustain your life exactly as it is right now? That's your freedom score. If the answer is a few months, you don't own your life, your employer does. So when you're in your 30s, 40s, even 50s, the question you should be asking isn't, how can I earn more? It's, how can I need less? Because freedom doesn't come from abundance, it comes from discipline, from the ability to say, I could, but I don't need to. And here's a paradox. The less you need, the more powerful you become. The man who can walk away from any deal, any job, any situation, that man cannot be controlled. If I could whisper something into the ear of every young professional today, it would be this: don't confuse movement with progress. Don't confuse activity with achievement. You can spend your whole life climbing a ladder only to realize it was leaning against the wrong building. So pick your wall carefully. Find work you can love, people you can trust, and problems that matter. And once you find those, stick with them long enough for compounding to do its work. Because the truth is, the big wins in life don't come from intensity. They come from duration. Staying in the game long enough to let patience, discipline, and time do what brilliance can't.